In this video, I'll go over Work Together, problem 13-1, and this is from our Century 21 Accounting Textbook, Advanced Edition 11, and this is by Gilbertson and Lehman, so credit to them for this problem and this book. We are on page 377, Analyzing Short and Long-Term Financial Strength. So, we have information from S&T Company's comparative income statement and balance sheet, and a form for completing this problem that's here is in your working papers. So we are calculating all of these ratios, right? The working capital, current ratio, quick, debt, equity, okay, all of those. And that's our first job. So working capital, that is our total of our current assets. So what I would do is just type an equal sign to start an equation for current year. So current assets, right, minus current liabilities, okay? So your working capital is, we are not going to autofill, $986,000. How about prior year? Equals, and if you're smart, you just drag this formula over because that should take the next column over. Yep. Okay, so 986,000 and 747,000. Okay, so where we want to be between 950 and 1.1. So current year, we are above the 950. So we've moved up from outside of range to within the range, right? Because 986 is in the middle of that. So that is favorable trend. We headed in the right direction. And the result is favorable, right? Because we are within the range. Okay. Next one. Current ratio equals current assets divided by current liabilities. And we'll just decrease our decimal places back to 2. So we're at 2.6. And for prior year, And for prior year, we were at 2.1. So we went up from 2.1 to 2.6. So we are in the target range, and we've also went in a positive direction. So both of these will be yes. Okay. Next is the quick ratio. And for that one, we do quick assets divided by current liabilities. So equals our quick assets divided by our current liabilities, and we'll just bring that one across, and again we'll maybe go down to like 1 decimal place. Okay, so we want to be between 0.9 and 1.3. We are not, right? We're still at just 0.8. So is this a favorable result? No, because we're outside of this range. But is it a good trend? Yes, we're headed in the right direction. If it continues, we'll be within range next year. Okay, debt ratio. So the debt ratio is your total liabilities divided by your total assets. Okay. So we'll move this over. We'll make it a percentage, actually. That will make more sense. All right, so with 1 decimal place, 41.7%, and that's down from 44.8% the previous year. All right, are we within the range we want, 38 to 42? Yes, we are. We were too high in the prior year, but now we're down within the range. So that is a favorable result and a favorable trend. Okay. Equity ratio. That one is total stockholders' equity divided by total assets. This is like just the reciprocal of this one, or like the opposite of this one. I don't know if reciprocal is the right word. All right, so we'll make that a percentage, 1 decimal place over, 58.3 this year, 55.2 last year. You want to be between 58 and 62. We are just barely, so that is a favorable result. and the prior year was 55, and we brought it up to 58, so it's a favorable trend because we went in the right direction. Okay, we brought it towards the middle of this range. Next one, common equity per share. Common equity per share is one that's going to require us to do a little bit of calculating, and the reason is we've also got preferred stock outstanding, right? So let's just do a couple of, calculations in the margin here. So what we know is par value of preferred stock at $100, and we know that there are how many shares outstanding? 1,200. So our preferred stock gets these two multiplied by each other. This is the preferred stockholders' share, right, of the equity, is this number. So now if we have to, let's figure out what our common share is. So we'll have to subtract that off. So what we know is the total equity, right, is 1.405. And then we've got to subtract that. So what's left after we subtract, this will be our common stockholders' share of equity, right, is this number. So those are important because we had to get rid of the preferred to figure out our common equity per share. So then we'll take our common equity and then we'll divide that, by the shares outstanding, which is 90,000, and now that gets us $14.28. Okay? So we'll do the same thing for the previous year, or the prior year. Still 100 par value, and the number of shares outstanding was only 1,000 that time. Okay? So then we should just be able to take our formula here, $100,000 of preferred share of the equity. So now what's our total equity from the year before? Here it is, the 1,227,500. And then how many shares was there? There was, not how many shares. We have to subtract this number off. My bad. And then we subtract, and we get 1,127,500, and that is your common stockholder share of the equity. Okay, so now we'll take this common number, and then we'll divide it by our shares outstanding of common stock, and we'll get $13.30. Okay. Is this within the range? 1428 is below the range, right? So we'll say it is not a favorable result because it's outside of our target range, but we went from 1330 up to 1428. So is that a favorable trend? Yes, we're headed in the right direction. Okay, interest coverage ratio. This one again has a little bit more that we have to calculate. So the first thing we need to know is our EBIT, right? Earnings before income taxes. And we can calculate that. And it's just your net income. Where are we at here? Net income plus your interest expense plus your federal income tax expense. Okay, that is your EBIT together. So after you've calculated that number, we can just put it in parentheses for order of operations purposes. And then we'll take it divided by our interest expense. And that should give us our interest coverage ratio of 14.9. Okay, and we should be able to just bring this across. So we went from 14.8 to 14.9, but we wanted to be between 16 and 19. So is that a favorable result? No, it's too low. But is it headed in the right direction? It's headed towards that 16. So yes, it's a trend that we can get behind, right? So we ended up with all favorable trends, but we did have 3 results that landed outside of our target range, so they weren't favorable results. All right, last part of this problem. List 2 ways that S&T Company can increase its interest coverage ratio. If you want to look back at your book, the interest coverage ratio is on page 376, and it's defined as the number of times a company can cover its interest expense with its earnings. Okay, so when we calculated it here, we had 3 items in our numerator, which were net income, interest expense, and federal income taxes. We'll assume we can't do much about income taxes, but if we increase our interest expense, it's also on the denominator, so that one doesn't make us much headway. If we really want to improve this ratio, it's got to come from net income, right? So increasing our net income would help us out. So that would be one thing we could do. So the other thing that we can do is we can decrease our interest expense, right? The less of interest expense in that denominator, it will help us. So maybe that means we could refinance some loans to be in a better situation or pay some off early if we had the cash for it. But those are 2 ways that we can increase our interest coverage ratio. So that is the work together for 13-1. And the on your own, very similar problem, but I'm going to let you do it on your own.